Welcome to the Skilled MBA Human Resource Management Case Study Series. At Skilled MBA, we analyze how rapid business transformations impact financial strategy, ethical governance, and long-term sustainability. Today's case features T Education Co., Lauti, formerly known as X Education, which evolved from a traditional tutoring service into a leading edtech firm. Key insights from this transformation include shift from service-based operations to platform-driven edtech business, requiring new accounting frameworks, emerging challenges in revenue recognition, cost capitalization, and investor communication amid rapid digital scaling pressure to meet aggressive growth targets while maintaining ethical and transparent financial reporting. The importance of aligning financial decisions with corporate governance, stakeholder trust, and regulatory compliance. This case presents a critical intersection of innovation, accounting ethics, and the responsibilities of leadership in a fast-evolving sector. T Education Co., Ltd., originally X Education, started in 2003 in Beijing with traditional math tutoring. It has transformed into a multi-channel education technology leader. This evolution presents challenges in accounting practices and ethical reporting, highlighting the impact of business transformation on financial reporting and the delicate balance between growth and transparency. Business model transformation reshapes financial reporting, demanding new practices. Accounting decisions influence investor perception and market valuation, highlighting the need for transparency. Ethical tensions arise between maintaining reporting standards and meeting performance pressures. Understanding the regulatory framework is crucial for education technology firms in emerging markets to navigate compliance and governance challenges effectively. T Education's journey began in 2003 as X Education, focusing on traditional after-school math tutoring in Beijing. Between 2016 and 2019, they embraced digital platforms, pioneering hybrid education services. From 2020 onwards, T Education evolved into a multi-channel education technology leader, diversifying revenue streams and adopting innovative business models. Revenue recognition in multi-year subscriptions, bundles, and platform fees is complex. Expense classification requires careful allocation between operating expenses, research and development, and capital investments. Governance demands appropriate segmentation and disclosure for diverse business lines. These challenges highlight the tension between short-term performance and long-term financial integrity. Prepaid multi-year subscriptions should be recognized over time to reflect service delivery. Bundled offerings require careful allocation to ensure each component is fairly represented. Platform commission structures can complicate revenue recognition, necessitating clear guidelines. Performance obligations must be assessed to determine if they are satisfied at delivery or over the service period. Aggressive practices risk long-term credibility. Determining whether platform development costs should be expensed or capitalized affects immediate profitability and long-term asset recognition. Segmenting expenses by business line enhances transparency but may expose less profitable areas. Classifying technology investments as research and development or operating expenses has tax and investor perception implications. T Education must align expense reporting with strategic goals. Accounting transcends compliance, acting as a vital communication tool that reflects a company's financial health and strategic direction. Ethical transparency in financial reporting is crucial, particularly in dynamic sectors like education technology. Building sustainable stakeholder trust hinges on ethical practices and clear financial disclosures, balancing growth expectations with long-term credibility and sustainability. Revenue recognition in EdTech must align with fair representation of business performance, especially for multi-year subscriptions. Ethical boundaries are crucial. Aggressive practices risk crossing into gray areas. Accounting choices significantly impact investor trust, affecting funding and market valuation. Segment reporting enhances transparency, revealing profitability variations across services, which is vital for informed decision-making. Emerging markets present unique challenges for edtech businesses, including evolving regulatory frameworks and varying standards between domestic and international markets. Cultural differences in transparency expectations and a fast-paced market demand rapid adaptation. Additionally, pressure from investors with diverse reporting expectations requires maintaining consistent accounting principles amidst these complexities. Corporate governance in edtech requires strong board oversight with independent directors skilled in finance. An audit committee should rigorously review accounting policies to ensure compliance. Implementing robust internal controls is essential to prevent reporting errors. Clear disclosure policies guide stakeholder communication, while regular ethics training for finance teams reinforces adherence to ethical accounting standards. Adopt principle-based standards to ensure consistent accounting across business lines, focusing on substance over form. Implement segment reporting to differentiate earnings by business model, enhancing transparency. Engage independent board members and establish strong audit committees for governance. Regular ethics training for finance staff is crucial for maintaining integrity in earnings management and financial reporting. This case study is perfect for courses in financial accounting, business ethics, corporate governance, strategic decision-making, emerging market enterprises, and edtech business models. Students gain insights into applying accounting principles within a dynamic industry, enhancing their understanding of ethical and strategic considerations in financial reporting. Integrity is crucial for sustainable growth. T-Education faces a choice: prioritize short-term gains or invest in long-term credibility through ethical reporting. Transparent financial statements foster trust, attracting quality long-term investors. This trust leads to stable investments, enabling strategic expansion and value creation, ultimately offering opportunities for ethical reporting and sustainable growth. Thank you for joining us. Explore more finance, accounting, and business ethics cases at Skilled MBA, where theory meets real-world strategy. For further inquiries, contact us at support@skilledmba.com or visit our website at https://skilledmba.com.